Kindly note that the views and opinions shared in this video are those of the speaker and do not constitute advice given by Classic Private Wealth. Any advice given by Classic Private Wealth will be in writing in the form of a wealth management proposal. Classic Private Wealth is an authorized financial services provider.
Just kicking off in terms of what is new, if you look back 2 weeks, you will see that the whole tenor of the conversation in the world and in South Africa has changed. And it's changed from, whoa, we are in deep lockdown and we will have to maintain this lockdown for quite a long time, to how are we going to come out of this lockdown. So in many states in the US, you're seeing that the lockdown is being lifted. In South Africa, we've gone from stage 5 to stage 4. If you're a smoker, that hasn't made a big difference to your life. But at least you can actually get out between 6 and 9 in the morning to go for a walk. That time of the morning doesn't suit me well, so I'm still going up and down the stairs inside the house. So not a big influence on my life. But the whole conversation has changed from how do we keep the virus under control to how do we revive our economies. And the fact that our economies has been starting to open up, or at least there's the point at which people can see some light in the tunnel. In places now like New York, the daily death rates are going down, the daily new admissions to hospitals are going down. So there's an impression that we've got the virus under control in many places, or that we are at least ready to move on. In a place like South Africa, we're saying we have spent the time we've bought by going into lockdown, by getting ready for the virus from a medical point of view, and we can go to a slightly lower level of lockdown. But there's the economic damage of the lockdowns are starting to become clear, and we're also seeing that a lot of people affected by the lockdown are now starting to say, but this is about as much of the lockdown as we can take, because people's financial resources, their accumulated food, their etc. is running out. In South Africa, we have the unique situation that the accumulated stock of alcohol and cigarettes are running out. And so a lot more people are actually getting into the situation where they are saying the lockdown needs to end. And markets have taken a very positive view of the relaxation of lockdown. So there seems to be an opinion in many places around the world that the worst of the lockdown is behind us. We'll be going into a less serious situation, and therefore markets have seen the worst of it. So if we can go back to the market graph, the world stock market graph, just to have a look. We'll go there. What you see there, again, is just the fact that the world stock markets very rapidly lost about 35% of their value and then kicked back to about 20% from the bottom. Now, one of the things that you learn in investments is that if you go down 50% and then up 50%, you're not back where you were. So we are still down about 20% on world stock markets. Now, just to give a comparison, in the recession of 2008-09, the financial crisis, world stock markets went down 60% from the top to the bottom. In 2001, world stock markets went down 50% from top to bottom. So if you're thinking about the downdraft of March as the full extent of the bear market, it was actually extremely mild, while the problems we're seeing in the real economy is actually extremely worrying. So we don't believe that markets have reacted in any way adequately in order to reflect the reality of the problems that companies will face over the next year or two. So we believe that stock markets should go down significantly more. And our view is still that we need to actually go down somewhere between 50 and 60% from the top, which means that markets can still go down 40 to 50% from where they are currently. So if we're at 80% of where we were before, a 50% downdraft from this point would take us down to 40% of where we were to start with. So we still think a further 50% downdraft is a real possibility, but it probably doesn't happen in one big swoop. It probably happens as a normal bear market, meaning markets keep going down for a while as information about the extent of the problems that companies are experiencing starts to come into the market. Now again, earnings season in the US will be July again. In July, we'll see the damage that the deep lockdown of the second quarter caused to companies. So that's probably a very difficult time for markets. And as the extent of the lockdown that's still needed eventually becomes clear, the markets are still likely to come down quite a bit more. At the same time, I want to quickly go through what's happened to clients of private wealth, just to give you an idea of what happened in March when markets came down. Our clients on the whole came through this in great shape. Firstly, because actually their planning situation is in place, meaning all of our clients have enough cash on hand to tide themselves through the next 6 years. If the crisis were to last 6 years, they'd all be able to live through it without touching their long-term investments. But even in their long-term investments, the bulk of our clients' long-term investments is in a strategy called the dynamic parity strategy. You can see what happened there is the dynamic parity strategy nicely participated. So the blue line, the top line, is the dynamic parity line, and the gray line is global markets. So you can see that when global markets really went down in the course of March, our clients didn't partake in the downdraft. They also didn't partake in the kickback because all the signals in the markets are still that volatility is extremely high and that risk is extremely high. And in fact, we've advised our clients who are in other investment pockets, not dynamic parity, where they're more exposed to equities. We've advised our clients to come out of the equities because we think that much better opportunities will present themselves. So our clients are in a very comfortable position. It's a highly risky situation, and they are fairly immune to it. So we can move on from this graph. Thank you. So I guess the question now becomes, what happens in markets in future, and how do we deal with that? So right at this point, our view is still, and it has been that for roughly the last month, is that there is, from a risk-adjusted point of view, no reason to be participating in stock markets. Meaning, we're at a situation where even if we're wrong and there's a V-shaped recovery in the economy and in markets, and we go back to a full normal, we don't really think that markets, once we return to normal, can be much higher than they were before this started, because the market was already at a fairly extended place before the whole thing started. So there are some arguments that interest rates will now stay extremely low for a very long period of time, and the discount rate you need to apply to profit should be lower, which means markets should go even higher. I think that that's a little bit of a stretch, because effectively the reason why interest rates will be so low is likely that the economy will be so weak, and that's why interest rates will still stay so low. So unlikely that profits will actually recover to where they were before very quickly. But even if it did, what that means is that you can see another 15 to 20% rise in stock markets. So no great shakes really if we miss out on that 15 to 20%, it really won't be a disaster. On the other hand, if we write that the economic problems are much deeper than is being anticipated and priced in by markets, then we'll actually see markets drift down, and in fact not drift down, but probably go down in a kind of sawtooth way, meaning that it will go down fairly rapidly from time to time, and then it will return to value, or it will go back up again, but not to where it started. So there will be a gradual down drift of steep falls followed by steep rises, but the rises never quite taking back all the territory that it lost until we are down quite a bit more than we are now. So how do we deal with that from a strategy perspective? The first point from our view is to say that we do think that things goes back to normal eventually, but we think it goes back to normal by roughly 2025. So it will probably we'll probably be in this 90% economy for about a year, so into 2021. And then it probably takes 4 to 5 years of very strong stimulus from governments to get the world economy back to where it was in 2019. Now, again, this is not so unusual. The economy in the Great Recession, the shrinkage in the economy was only taken back by about 2014. So 2008's levels were only reached again in 2014. So we probably see something similar. 2019's levels are only seen again in 2025. So we miss out on about 5 years of normal growth in the world economy and in stock markets. So we do think it goes back to normal eventually, and stock markets also goes back to where they were before, but only after about 5 years. So we think that the level of world stock markets in 2025 will probably be roughly similar to where it was in 2019, which means that if stock markets were to go down 60% from top to bottom, there will be a fantastic buying opportunity somewhere around the end of 2021 or early 2022. And our assessment of it is that if stock markets were to be down 60% from the top, that would be a signal for us to re-enter markets for our clients. And they will still experience some severe volatility after that, because we don't think that markets go straight back up, but we think there's a 5-year bull market that follows the downdraft, and that there's actually very little risk if you just sit it out, or the ups and downs. You'll actually go up by somewhere between 100 and 150% in shares between 2022 and 2026, if you like. So we think there's a period of very high, very dependable returns that will come after a period of some severe downdraft. So the next question is, what if the stock market doesn't go down that much? And the second answer is, if we look at it from an economic perspective, we would start investing at the point where we think that the depth of the recession is recognized generally, and that governments have started putting enough stimulation in place to deal with the depth of the recession. So remember, this is not just the depth of the recession that's caused by the lockdown. This is the depth of the recession that is caused by the lack of business confidence and the lack of consumer confidence and the lack of government confidence at the back end of this. So one of the things we've got to also deal with is that governments will not necessarily act rationally in this situation. In places like the US and even the European Union, there will be lots of political differences about how much stimulation should go into the economy and who should be the beneficiaries of that. And that will mean that they are likely to be slow in putting enough stimulation into the economy. From our point of view, we think that there's probably in the US, there's probably another $1 trillion needed just in relief, disaster relief, over the next 6 months or so, because of the 90% economy, not because of the 70% economy anymore. But they then, from 2022 onwards, they will need at least $5 trillion of stimulus into their economy in order to deal with the depth of the recession that they will find themselves in. So over a period of time, another $5 trillion will have to go into the economy. So we don't think that we should be putting our clients back into the market until the $5 trillion is at least on the horizon. Now, markets always look forward, so you should be careful not to get caught. But we really think that there will be much better opportunities to get into stock markets. If we're looking around us, there is some other effects of the financial part of the crisis that we are already seeing. So one of the things that happened is that when we had the very fast downdraft in stock markets, that created a liquidity squeeze around the world. And that liquidity squeeze in the developed markets was dealt with quite adequately by their central banks. So the Fed, the European Union, the Bank of England, the Japanese, and so on, dealt with the shortage of dollars fairly quickly. But even in a place like Britain, the pound went to the weakest it's been since 1985, just because there was a lack of dollars. As people moved into cash, there just wasn't enough cash around, so there was a squeeze, and that squeeze manifested itself in a severe downdraft of emerging market currencies. So if we can put the currency graph on, please. Obviously the rand is the most highly traded of all emerging market currencies, and in South Africa we also experienced at the very same time the South African debt was downgraded to junk. Please, that's what I'd like to see. So the downgrade to junk was actually something that meant that we saw the rand going much weaker with other emerging market currencies, but there was some local content to that as well because of the downgrade to junk. Now, other emerging markets are also kind of junk or close to junk, so not that unusual. But at the same time, what happened in virtually all of those countries is that the weaker currencies also spilled over into their bond markets. So what you see in South Africa is a very severe steepening of the yield curve. So what you see is that the interest rates paid on government bonds in South Africa, there you see the currency graph coming up. So you can see that this graph gives the rand in real terms, meaning we are now on the week roughly as weak as we were during the Des van Rooyen weekend. You remember the weekend when we had the cleverest Minister of Finance in the world. During that week, we were roughly as weak as we are now with the world economic crisis, but we're not as weak as we were in 2001. So in 2001, the currency panic was significantly worse. Then we went to the current equivalent of about 22 rand to the dollar. So we seem to have stabilized at roughly 18 to 19 rand to the dollar. But you see there that the average for the rand is around the 14 rand level. And one standard deviation away is around the 16 rand to the dollar level. So we think that when liquidity constraints around the world dissipate, the rand will go back at least to within one standard deviation of its long run average. And therefore, you can also see, if you look back to 2008, you can see that the rand was very weak briefly. It went one standard deviation weaker, but it then, after the crisis, strengthened significantly. So what we might actually see in the rand is that when everybody around the world starts stimulating their economies through very large infrastructure projects, those infrastructure projects are intensive in the stuff that we export, things like iron ore. So actually, the commodities boom of the 2000s may well return in the 2020s, and the rand may well actually experience another period of strength. But the rand is not the only currency. This same phenomenon has repeated itself around the world. So we think that one of the opportunities that will dissipate fairly quickly, but again, we can expect some volatility, because if equities start having more downdrafts, the same liquidity constraints might reappear from time to time. But we think that emerging market currencies and emerging market bonds already offer some very good value, and we are advising some of our clients to participate in those. Maybe let me just make some comments about what is happening in South Africa as well, because that also affects our clients in a significant way. What is new over the last 2 to 3 weeks in South Africa? First of all, obviously, we've moved on from stage 5 to stage 4, but actually the difference between stage 5 and stage 4 is very small. There's only a small number of industries that are coming back, and those industries are coming back in, mining is only allowed to go to 50% of capacity and so on. So even those industries that are allowed to start coming back will come back very slowly. So the economic recovery in South Africa after the deep downdraft of the last 5 weeks of lockdown is likely to be quite slow. And what we're also seeing is that the distress experienced in poor communities has really ramped up significantly. So we're seeing every day you read about riots or near riots when food packages are being distributed, riots or near riots when people are not paid their grants correctly, protests of various sorts erupting. So what we would say is it is actually, from a political point of view, quite a dangerous situation, because we've got great suffering in the vulnerable communities, and we have a very unsympathetic police and army out there trying to maintain a fairly strict level of lockdown. So it doesn't take a lot of imagination to see that at some point people come out and raid some food stores, not to mention liquor stores, and that some of them get shot by police and army, and we have another Marikana on our hands, and that might have some severe repercussions politically. And so we think that this is actually quite a dangerous situation from a political point of view. So we're a bit nervous about that situation, but the most likely outcome is that we gradually relax, that the 500 billion of relief that has been budgeted gradually reaches the affected communities, and that we come out of it in reasonable shape economically. But the most important thing that's likely to happen in the short term in South Africa is we're going to see a really severe epidemic of the virus. So the whole emotional content of what's happening in South Africa will change over the next 2 months. So at the moment, it's the content is, why are we being locked down so strictly? In 2 months' time, the question will be, why are there so many people dying? So when you get a really severe epidemic and the medical resources are overwhelmed and a lot of people are dying, the emotional content in South Africa will change quite significantly. And we think that it will be quite difficult for the government to go to much more relaxed measures of lockdown while people are getting ill all over the place. So we think that the government is going into a very difficult situation, and it looks like their instincts are to lock down more strictly rather than less strictly. So it looks like we are going to have some fairly severe form of lockdown in South Africa until the epidemic abates. And that's only likely to happen maybe in August or September. So we should be preparing ourselves for a fairly severe form of lockdown for another 2 to 3 months, at least. So to summarize, we think that the one place that offers good value in markets is emerging market bonds. We think bond rates are too high. South Africa is included. So if you're buying some South African bonds, you're likely to have a very nice return on that over the next year. We also think that emerging market currencies are undervalued. So if you're buying into emerging market currencies, you're likely to get some good returns on that over the next year, although you should expect volatility to remain quite high over that period. At the same time, we think markets are being extremely generous in offering investors a chance to get out of equity markets while markets are still at fairly elevated levels. So we think that it's a fantastic opportunity to actually be selling some equity. So our own clients actually have very, very low levels of exposure to equity at this point. But when we're engaging with potential clients, our recommendation to them is to liquidate at least half of their equity portfolios, utilize the current opportunity to get out of equities at reasonable levels and to wait for better opportunities. We think that we'll be able to go back into equities towards the end of the year, early next year, and then sit tight for quite a long, strong bull market. We also think that the value portion of the equities markets are underestimated at this point. So we think that the value portion of equities is probably where the most reliable long-run returns will lie once we get through this crisis. So I think that's enough from me. Shall we have some questions or comments?
Thanks, Wikus. The first thing to tell people who are attending is that there is a recording of this, and we will be. It takes a day or so to edit it, and we will be sending all of you a copy. Those who want to have one, and we've found it quite useful to have. As a reminder, because Wikus has talked for some time and you may just have missed one or two points. Any other questions around?
I think that we've made people so excited about the great opportunities out there that they've dumbfounded. So I think that if we don't have questions or comments, maybe the optimistic comment about this is that this may be the catalyst, if the politics are played correctly, for the president to really move on to a proper restructuring of our economy. So we're one of the first economies in the world where the president, when he announced the move from level 5 to level 4, also actually announced that at the end of the coronavirus crisis, there will be a fundamental shift in economic policy and that we will restructure the economy in a new way. So hopefully that means that the state capture faction and the radical economic transformation faction will be sidelined for good, and that we can rebuild the South African economy on a much better basis once we're through this. At least things like, economists like to say that you should never waste a good crisis. So all is not lost, but we are facing quite a few difficult months yet.
Because the other thing was, what was worrying to me was the fact that when Cyril made the announcement about cigarettes and it was rescinded the next day, yes, there seems to be quite a lot of argy-bargy going on at the top level, and that is a worry to me.
Lee, I think you're absolutely correct. What's happened is that in the initial stages of the crisis, both here and overseas, there was a kind of thing that said we shouldn't be playing the normal politics for the moment. We should be focusing on dealing with the virus. What is happening around the world is that those political differences are coming to the fore again as people kind of get to the next stage. And I think that in South Africa, we're seeing a very severe power struggle at the top level. And that power struggle hasn't stopped. And there are the people with the more liberal instincts, and there are people with the more prescriptive instincts. And unfortunately, it seems that in South Africa, the people with the more prescriptive instincts are, for the moment, winning out in the short run. And I think that is a worrying sign. On the other hand, it may create an opportunity for a fundamental shift in economics. And we have, for a long time, we've had the view that if you were to just take Cyril Ramaphosa out of the equation, so let's say for some reason Cyril is not available for the next 5 years, that you would see a reshaping of the political structure in South Africa, and that you would see coalition politics coming forward. So you either see a coalition of the DA and Herman Mashaba and so on, with the liberal wing of the ANC, maybe led by someone like Tito Mboweni, or you see, and they come to power in coalition, or you see a coalition of the more radical elements, so the state capture or radical economic transformation faction, the Ace Magashulas of the world, allying with the EFF in order to form a government. And if the latter was to come to fruition, that would be a really, really worrying day for South Africa. So I think we are on a knife edge from a political point of view.
Yeah, thanks, Wikus. That's all from me. I know we are out of time, but perhaps it's something we could address next Wednesday. Just for everybody's note, we have these talks every Wednesday, and I think Wikus can address it next Wednesday. There's somebody else wanting to ask a question.
Lee, it's Keith. I just wanted to ask one thing, because thanks very much for today. Most interesting. Have you had time to look at this report that was referred to yesterday about the actuaries and economists who've saying that the restrictive lockdown, I'm reading from it, will cause a humanitarian disaster to dwarf COVID-19, and that the group says that if the current lockdown is not lifted, it may cause 29 times more deaths than the measures aim to prevent? Is there any credibility behind this?
I think that kind of coming up with exact numbers in such an uncertain period is not really realistic. What I would say is I think we've been remiss in getting help to the needy in South Africa quickly enough. When we announced the lockdown, we should have, within a couple of days, announced the assistance packages. And I think that the state's ability to distribute help to poor people in a good way is very, very limited. What I do think is that so I think that it is correct that poverty kills eventually. And if we now induce a lot more poverty through this lockdown, then a lot of people will die because of hunger and all kinds of poverty-related issues. But I don't think that the conclusion that will happen is actually correct, because I think that what's going to happen is the virus is going to overtake us. So what will happen is we'll have a very quick, very severe epidemic, and then we'll be out on the other side and all of the restrictions can be lifted. So I think that the questions are somewhat academic, because I think the virus will overtake it.
Okay, thank you.
Are there any more questions? If not, thanks again, Wikus.